Hello and welcome back. In our last session, we introduced the four main financial statements. Today, we begin the essential work of understanding how those statements are built from the ground up. We will be deconstructing business transactions to see how they fit into the accounting cycle. Think of yourselves as financial detectives. We're going to examine the evidence of a business event and deduce its precise impact. Here is our roadmap for today. We'll start by defining what makes an event a recordable transaction. We will then outline the 6 core steps of the measurement process that accountants follow. The bulk of our time will be spent analyzing the dual effect of transactions using both the basic and the expanded accounting equations. Specifically, we'll master the effects of revenues and dividends on a company's financial position. So, what is the first filter? What makes an event worthy of being recorded by an accountant? An event becomes a recordable transaction only if it affects the financial position of the company, meaning its assets, liabilities, or stockholders' equity, and it must have that impact. Today, we are primarily concerned with external transactions, which are exchanges between our company and a separate outside party. Let's apply a quick litmus test. If Walmart hires a new employee, is that a recordable transaction at the moment of hiring? The answer is no, because simply hiring someone doesn't change the company's assets or liabilities. But what about when Walmart later pays that employee's salary? Absolutely, yes. At that point, the company's cash, which is an asset, decreases. The accounting cycle follows a systematic measurement process, which consists of these 6 steps. First, accountants identify the accounts affected by a transaction, often by looking at source documents like invoices or contracts. Second, they analyze the transaction's impact on the accounting equation. Third, they assess how the transaction affects accounts using debits and credits, which we will cover in detail soon. The final 3 steps involve recording the transaction in a journal, posting it to the general ledger, and ultimately preparing a trial balance. Today, our entire focus is on mastering that critical second step, the analysis. To perform this analysis, you need a toolkit. It consists of 3 questions you should ask for every single transaction. First, what is one account affected, and does it go up or down? Second, what is the other account affected, and does it go up or down? And third, the golden rule: do assets still equal liabilities plus stockholders' equity? The answer to that last question must always be yes. Let's put the toolkit to work. Our company issues stock for $200,000 in cash. First, we see that the company's cash, an asset, increases by $200,000. Second, the owner's claim on those assets, common stock, also increases by $200,000. The dual effect is clear, and our equation remains perfectly in balance. $200,000 in assets equals $200,000 in stockholders' equity. Now for our second transaction, borrowing $100,000 cash from a bank. We begin with our previous balance where cash and common stock were both $200,000. First, our cash, an asset, increases by $100,000. Second, our obligation to the bank, a liability called notes payable, also increases by $100,000. Our equation again balances. Total assets of $300,000 equal $100,000 in liabilities plus $200,000 in stockholders' equity. It's time to level up and look deeper inside the accounting equation. We know that stockholders' equity is made of 2 parts: common stock, which is owner contributions, and retained earnings, which represents the accumulated profits of the company. We can expand this further. Retained earnings is driven by 3 items. It's increased by revenues, and it's decreased by both expenses and dividends. This gives us the expanded accounting equation, a much more powerful analytical tool. Let's use this new expanded equation to analyze a revenue transaction. The company provides a service and receives $43,000 in cash. On the asset side, our cash increases by $43,000. On the equity side, this transaction represents revenue earned, which increases retained earnings. So, retained earnings also increases by $43,000. The equation remains in balance. But why does revenue increase equity? This flowchart tells the story. When a company earns revenue, it increases its net income for the period. That net income, if not paid out as dividends, increases the company's retained earnings. And since retained earnings is a direct component of stockholders' equity, an increase there flows through to increase total stockholders' equity. It is a direct and logical link. The logic for expenses works in the opposite direction. When a company incurs an expense, it causes net income for the period to decrease. A lower net income results in lower retained earnings. And since retained earnings is a component of stockholders' equity, this ultimately causes total stockholders' equity to decrease. Now let's talk about dividends. Like expenses, dividends also reduce retained earnings. However, and this is a critical point, dividends are not expenses. An expense is a cost incurred to generate revenue. A dividend is a distribution of the company's profits after they have been earned. It's a sharing of the spoils with the owners, not a cost of doing business. This brings us to a very common mistake that students make. It's tempting to think that paying a dividend increases stockholders' equity because from the owner's personal view, they are receiving cash. This is incorrect. You must always analyze transactions from the company's perspective. When the company pays a dividend, its resources, specifically its cash, decrease. Therefore, the owner's claim on the company's now smaller pool of resources must also decrease. So, here is our complete analytical tool. Remember that every transaction has a dual effect that keeps the equation in balance. Assets are increased by investments from owners and revenues earned, and they are decreased by expenses and dividend payments. Liabilities are increased by borrowing. And finally, equity is increased by owner investments and revenues, and it is decreased by expenses and dividend distributions.